Very pleased to welcome our keynote speaker this morning. Before becoming a journalist, Nomi Prins worked on Wall Street as a managing director at Goldman Sachs, senior managing director at Bear Stearns in London, strategist at Lehman Brothers, and an analyst at Chase Manhattan Bank. And now she's the author of several books and a regular contributor to multiple TV networks, including CNBC, CNN, MSNBC, Fox, and PBS. This is how excited I am personally to have Nomi joining us. When she arrived at the hotel yesterday, I just happened to be in the lobby, kind of flirting with the ladies at the registration desk. I was looking down, and then all of a sudden, there she was. And I kind of like involuntarily kind of lunged forward and gave her a hug. And then I was thinking, boy, I think I've only met Nomi twice. And the first time we were on a panel together, and we didn't really talk. And the next time was on YouTube, and I don't even know if that counts. So I just grabbed a woman that I've never met before, and I'm scared to find out what the consequences of that are in 2019. I'm thinking at least I'm going to get a letter from corporate, please don't hug the guests, Albert, you know. I don't think James Rickards has anything to worry about, but if Danielle's in the audience, just stay away. I might lose control. Her talk today is How Central Bankers Rig the World. Please welcome Nomi Prins.
Thank you so much for that intro, Albert, and the second hug. So now we're all good on all of the hug thing. I would just want to thank everyone here and all the people at Sprott for allowing me to speak to you this morning. It's really just such a great honor. I've met people here from New Zealand to Australia to Germany to Seattle, and it's just been amazing. So thank you all, and thank you for being here at the morning talk. Get caffeinated. We're going to cover a lot of things in the next half hour. If you're not already caffeinated, just grab the cups, keep them next to you. I want to talk a little bit about Lehman Brothers. Rest in peace. When I was working at Lehman Brothers, I was also doing graduate work at NYU in statistics. And one of the things that I have not thought about in many years was that I was doing something called geostat, which was a branch of statistics, which some of you might be knowledgeable about, the wonkier of you in the audience, because it was an analysis of basically what's happening beneath the Earth's surface, and the idea that you could analyze things that were going on in terms of the patterns of geophysical properties. So that if you had a mine in a particular place or you found gold in a particular place, that the likelihood of there being a find near that spot or there being a cluster of spots that were occurring somewhat near each other was higher than if they were further from each other. And the idea was that, and I didn't think about it in terms of mining per se back then, but it was the concept that things that kind of operate together continue to operate together. So it was the sort of mining equivalent and the statistical equivalent of bodies in motion stay in motion unless they're acted upon by an outside source, but in a physical, multi-dimensional construct. So one of the things that I did as I was studying that and multivariate analysis and all this other sort of mathematical statistical stuff was that I was also working on the trading desk and options and futures at Lehman. And so what I would do every evening in order to go to my classes at NYU is I would change clothes from my business outfit. I'd duck into the restroom at Lehman. I'd Wonder Woman spin into jeans and sneakers, and I'd make my way up to NYU in the Village, because you can't really do that in heels in the amount of time I had, which was I was always 3 minutes late to my stochastic analysis class, which this Russian professor was really not very fond of doing. But I always sort of duck in, slide into my seat and sit there and be like, okay, just made it out of Lehman Brothers. But one of the things that I learned on that whole experience is that I went around the world with Lehman Brothers. That same time I was doing those particular classes, and it was my first introduction into central banks. And the reason that happened was because when I was working on the futures and options desk as an analyst, there was a salesperson who was incredibly aggressive. I mean, imagine that, an aggressive salesperson. But what he would like to do is take credit for the analysis that I was doing, which, was part of his sales thing. But we used to kind of duke it out. So Albert, I've gotten so much better on the anger thing since then, so no worries there. But we used to sort of duke it out on the trading floor because I would say, no, this is what should be happening. You should look at the real world. Yes, it's about models, but it's also about real activity. And he would just be like, I don't care, we're just going to sell this stuff. And it got wordy, it got heated. So Dick Fold, who was the CEO of Lehman Brothers at the time, thought that the best way to handle our fights on the trading floor was to stick us in a plane together and send us around the world. And whoever came back won. If we both came back, great. If we didn't, whatever, you just hire someone else. So the first place we went to was China. And at the time, the first central bank we went to was the People's Bank of China. And it was very nascent in terms of their activity in buying U.S. Treasury bonds. So the whole idea of these primary dealers, which Lehman Brothers and other major banks in the U.S. were, was to try to figure out ways to sell as many treasuries that they were getting in their pocket out to the rest of the world. And central banks obviously are a large buyer of U.S. Treasury bonds. And so we had to basically explain why that was all good to the People's Bank of China and what would happen if the U.S. couldn't make good on their bonds, or in general, if any country couldn't make good on their bonds. And so this precipitated a whole series of traveling throughout Asia. So the Philippines, Malaysia, Hong Kong, and basically all the central banks to try and get them to buy more treasury bonds. And it worked. As Jim Rickards mentioned yesterday, the Central Bank of China has about $1.4 trillion worth of U.S. treasury bonds now. That's one of the reasons that they don't sell them, because they own them. They don't want to sell them. It would make our treasury bonds look worse. So there's other things that stay in equilibrium because of that. Over the years, as I left that element of banking and moved to London, I stayed in that realm of working with central banks, of working with investors around the world and trying to come up with strategies that could help them to both buy the products that banks were selling, but also to hedge themselves against any economic downfall, any geopolitical uncertainty, or anything else that could really get in the way of them sort of keeping these assets, continuing to buy them, and continuing to do well off of them. That precipitated developing a little thing called credit derivatives, which I didn't personally develop, but I was around London at the time that they were being developed. What do credit derivatives do? Not to get really too wonky on this, but they basically are designed officially to protect those that buy them from credit default situations, from a government going down, from a company going down. And the idea is they're supposed to head a credit event, which is an event you're not supposed to be able to necessarily know is going to happen, but it might happen. Credit events and credit derivatives were at the core of the financial crisis of 2008. Why? Because all the bankers decided, having developed these securities over years, is that if they could figure out a way to offlay that credit risk to other people, to other institutions, if they could insure it multiple times, they could get out if things got really bad. And as a result, they had a get out of crisis free card. But the way it really worked was when the subprime crisis happened and the mortgage crisis happened in the US, they couldn't get out fast enough. Because when liquidity goes away, when the market goes away on anything, you cannot get out. You particularly can't get out if you don't have a plan, and I'll talk about why that relates to central bankers in a moment, but you can't get out if there's no market. And that's really the reason that the financial crisis happened. There's been lots of books. I contributed to them. I wrote a little book called It Takes a Pillage back in 2009 when the private banks, the large institutions that had created the credit derivatives, that created the credit crisis, that created the financial crisis, got bailed out by a larger set of institutions called central banks, which are still effectively benefiting financial institutions by subsidizing them to an epic record amount of money through quantitative easing, through keeping rates low, for keeping the cost of money to banks low, and all of the different tools that central banks took out in the wake of the financial crisis to help banks stay alive. Now, certain banks didn't stay alive. Lehman Brothers didn't stay alive. The bank I went to work for in London, Bear Stearns, also didn't stay alive. So that would be 2 out of 4 banks I worked for no longer exist. So one investment strategy don't buy stock in a bank I work for. I don't work for any banks right now, so we're good. I don't know if any banks would hire me back, so we're probably also good. But just in case that happens, it's just a little investment tip I give to you. But what happened in the wake of that financial crisis was what I call sort of phase one of the central bank collusion that I wrote about in my last book. And that was this. Before the financial crisis of 2008, central banks, yeah, they operated together. Yes, they kind of dealt with backing the various currencies, in particular the US dollar, so that banks in the countries throughout the world could have enough access to dollars when things got tight, when things got tricky, because that is and was the prevalent reserve currency of the world. It was the currency in which these central banks reserved assets in order to translate them into capital, in order to inject them into their financial systems. So that was a thing. But what was different, as we've all come to recognize in the wake of that financial crisis, is the magnitude, the sheer size, not just of the amount of subsidy, of liquidity, of capital, of cheap money that was given to the financial systems throughout the world, by in particular the G7 central banks at first during phase one, but it was the sheer fact that there was no limit. There is no and was no legislative or any other kind of limit that says to the Federal Reserve, you know what, you can only increase the size of your balance sheet by X. We would think that 0 was a normal limit for interest rates to go to, but that's not even a real limit, because we know that interest rates in Europe, interest rates in Japan are actually negative. So that's not even a limit. Rates don't have a limit. The size of the book of assets that a central bank can create money to buy from the market, from banks, whether it's buying those treasuries back from US banks, whether it's buying corporate bonds in Europe back from corporations, whether it's buying equities or stocks back from companies in Japan, none of that has a limit. And as a result of that no limit experience, central banks didn't create an exit plan. If you don't have a limit, your exit is kind of, well, let's just hope things don't get worse and let's just keep things going. And that's what ultimately happened up until 2015. So from the period of time between 2008 and 2015, what was going on was predominantly the G7 central banks were, I call them colluding. I don't use the term as the term is used in our politics of Russia and Trump and et cetera. I use it as actual getting together and effectively manipulating, whether by design or whether by experience or whether by it just happened that way, markets. And that is what central banks ultimately did. If you inject what became about $22 trillion worth of capital, of created, fabricated money into the financial system, that's a big event. That's like, I don't know, finding lots of different gold mines in a spot you didn't think they existed before. I mean, how cool is that if you're in that business? That is a neat thing, right, for anyone who benefits from it. And from the standpoint of how they worked together, it started in an emergency situation. It started in that fall of 2008 when Lehman died, and it became something that went around the world. By 2015, there was some semblance that maybe the Fed was going to reverse that policy, and they were possibly going to take rates from 0, and therefore all of the following G7 central banks that had been sort of copying them and working together to create all this money into the system, because when US banks failed, they failed big. They didn't just fail for the US. They didn't just need it to be bailed out by the Fed. They, because of the global interdependency of banks, they needed to be bailed out by the entire set of G7 central banks, and that's ultimately what happened. Those subsidies that existed happened. 2015, I get invited to the Fed for this. They have this 3-day conference that the Federal Reserve, the IMF, and the World Bank do every year in Washington, and it's a closed door kind of experience, and different people speak and so forth. And I was speaking at the first day, which was the Fed day, and then it moves to the IMF, then it moves to the World Bank. So I was asked to speak on why Wall Street wasn't helping Main Street globally, Main Street domestically, Main Street, with all the money that they were getting. So this was a thing that was discussed, within the Fed, within the central banks around the world, within the community of central banks around the world. And they were sort of pondering on, well, why isn't Wall Street, sort of giving away the money we gave them? And before I get up to talk, it was a morning talk, just like this one. I wasn't wearing yellow, I was in a suit, and it was a little bit more, well, Fed-like. But so I get up after Janet Yellen speaks. Now, it was Janet Yellen, it was a bunch of guys from the Treasury Department, Assistant Treasury Secretaries. And both of those groups, Janet Yellen and the Assistant Treasury Secretary, said everything was fine. Banks are good, they've got capital, they've got money in reserve, no crisis is going on. We sort of dealt with that little credit problem in Europe in 2012, got through that, ECB helped out, everything's good. Regulations are fine, we basically have a plan in Dodd-Frank, and that's gonna help banks from going amok again. And in the background, Christine Lagarde is having this sort of background battle, head of the IMF with Janet Yellen. It wasn't really in the background because it got onto the front pages of some of the papers around that week, which was basically that the Fed might want to raise rates. And Christine Lagarde, head of the IMF, is saying, yeah, but if you do that, all of the debt that's been created on the back of the fact that this money has been so cheap and it's sort of proliferated the world, especially the emerging market countries throughout the world, are going to have really difficult issues in paying back all that money they borrowed because it was so cheap. So this is all going on in the background. The morning happens, Janet Yellen saying everything's great, Treasury Department saying everything's great. I get up to talk and I said, look, well, first of all, I wasn't even sure that they had gotten it right when they invited me, because I had written some rather, critical things about central banks and the Federal Reserve and their relationship with Wall Street. But I had checked, and they did in fact want me there. I don't know if everyone wanted me there, but I was there. And I said, look, I talked to a room full of basically central bank leaders. And I say, look, if you give someone a lot of money and you put no restrictions on how they can use it, and they don't use it the way you may want them to use it, why would it be a question as to why that's not happening? Central banks were asking Wall Street to effectively be benevolent and altruistic and decide to create strategies to use what they had to help the real economy. And they didn't have to. I mean, why would they? I remember that when I was working for Bear Stearns, we had this credit conference for securitization, for basically the compilation of lots of securities, lots of loans into one, and how we would sell them. So we're all out this shindig in the middle of some French chalet. I mean, it was beautiful, it was groundy, it was nice. And all these people came from around the world to be there. And late at night, they had one of these library conservatory kind of areas, and they had all this really expensive honor bar type liquor. And it was really expensive. That's all I know about it. But I also know that some of the heads of our company were trying to top up the liquor with water from the pitcher there, to not have to pay this honor bar at this really expensive chalet shindig, for which we were probably paying a lot of money anyway. So on the margin, they were sort of skimming off the top, even though they didn't have to. So, I mean, this is the mentality we're working with. We're working with people, there were fights going on at Goldman Sachs routinely over what property lines were going into each other's property lines in the Hamptons, which is, so this glorious place in Long Island, because one person had more of a, piece of the ocean sort of reeds than the other in that particular moment. And so they care about stuff on the margin. So if you give them a whole pile of money, they're not going to just give it away. They're going to tighten it. I mentioned yesterday during the macro panel that one of the things that has happened is consumer debt's gotten really high, but it's also gotten really expensive. So banks have been getting money really cheap, and the rate of credit to consumers, particularly through credit cards, is actually at all-time highs. Go figure. So going back to that minute in front of the Fed and the IMF and the World Bank bankers, I said, look, they're not giving away the money the way you want them to because nobody made them. It's really, really simple. So if you want to have that money go into real things, you could decide to divert it to that effect. You could decide to explain that it does have strings now. You can say, look, you had 8 years of free money. Maybe now you need to do something with it that's more real growth oriented, real economy oriented, not just financial assets bubbly oriented. But they didn't do that. Instead, what happened is, after the whole Lagarde-Yellen kind of battle, the Fed did raise rates for the first time in 8 years in 2015 in December by 25 basis points, that tiny little amount that was eased this week. And that 25 basis points in December made a lot of markets really unhappy come January. So January comes, markets dump in the beginning of the year. Why? Because they think that all of this free money stuff is going to come to an end. Nobody wants it to come to an end. The banks certainly don't want it to come to an end. Anyone speculating in the market doesn't want it to come to the end. And what happens, oh my God, if it comes to an end? Well, then you do get the situation, potentially, and we didn't yet, that Lagarde was talking about to Janet Yellen, which is that all that debt out there might be difficult to be repaid. There could be another credit crisis. There could be another liquidity crunch. And what are we going to do then? And as a result, ultimately, not because of pondering the question, just because of being afraid, the Fed did sort of stop for an entire year in its rate hiking exercise, and there wasn't another rate hike until the end of 2016. Meanwhile, I'm sitting there writing a book. I'm not sitting and writing a book. I'm actually like traveling around the world because something just hit me as I was talking to all those central bankers from around the world at the Fed, which is that they, especially the ones from emerging markets, especially the ones from places sort of between markets, like Brazil, like Mexico, they have large economies, but they're not necessarily privy to directing what happens with monetary policy. They're just kind of reactionary, or have to be reactionary to what happens. And as a result, there's a lot of political unrest, there's a lot of economic volatility, there's a lot of things going on in their countries because they can't be the leader. They can only be the follower of what cheap money is doing in the bigger G7 countries throughout the world. China is doing something else at the time. They're basically saying, look, what you guys are doing at the Fed is really kind of creepy because you're potentially creating all these bubbles, and we're going to have to potentially deal with the fallout of another economic crisis, and it won't be our fault this time any more than it was last time. So what China's central bank is doing and what Asia is doing is they're collaborating on trade agreements. They're collaborating on taking money, creating it anyway, but using it to grow their partnerships and to actually build stuff around that part of the world and create relationships outside of their reaction to what the Fed was doing with interest rates and what the Fed was doing with cheap money for the major developed countries. So I start to go around the world and just talk to people on the ground. I kind of, in collusion, my chapters are sort of geographical, and I go from Mexico to Brazil, to China, to Japan, to all sorts of places in Europe and the UK to just really follow that money and follow the behavior of how outside central banks actually impacted the real economy and real decisions and the real financials and just real people on the ground. And how it also impacted politics. And that's a whole other conversation here, but one of the things that I found is that the countries that had to react, like Brazil, which has messy politics anyway. I mean, it's nuts. I was there during some of the revolts that were happening around the former president, Dilma Rousseff, and I was there when the new president, Bolsonaro, ultimately when I came back, was elected. They've had a lot of turmoil. But they've also had to react to central bank policy from the US. So has Mexico. So has a lot of the emerging markets. So now we get from phase one of creating that money, creating the inequality, creating instability outside of the G7, and looking at how that collusion amongst central banks actually impacted the real world outside of these countries and throughout the entire globe. And so now we're in phase two, which is same stuff, different time. Phase two started potentially this week. It may or may not, but it started with a cut. It started with the Fed saying, and we can debate this, why they said it, why Powell did this, how he did it, what he meant. But the fact of the data is that we've gone from cutting rates creating big balance sheets at these financial institutions, at the central bank, buying all sorts of assets in all sorts of financial sectors throughout the world, in bonds, in stocks, and in government debt. And we're starting it all over again. But we're starting it from a more precarious place. This is not white swan stuff, like Rick was asking us about yesterday. Although white swans are actually vicious. I mean, I don't know if any of you have ever tried to like feed a white swan. They're not really better than black swans. It's just like a term. They're mean. They can be mean. There's inner anger in that swan. But so now we're talking about a phase 2 from a position of greater weakness throughout the world. We're talking about a phase 2 where debt to GDP globally, if we combine government and corporate debt globally, is about 3 to 1. That means we have to basically borrow 3 times as much as the capital that we use to do anything every time we want to do anything. And that's if we're going to use that borrowed money to do anything besides reinvest in financial assets. That's if there's a plan. So we have an extensive amount of debt now throughout the world. And we also have a sort of artificiality of lift in the stock markets, in financial assets throughout the world that's come from the manufacturing of this money and now the remanufacturing of this money. Central banks never had an exit plan. I actually end my book, Collusion, talking about the fact that there was no exit plan. And the hardback of the book came out last May, the paperback this May. But the idea is that they didn't think about, well, how do we get out? There was never a get out plan, not by any of these central banks. And so now in phase 2, there's a get back in again plan. The Fed not only cut rates by 25 basis points, we can again debate later what that means, but they also said we're not going to shrink our book of assets anymore. So having grown through quantitative easing, the Fed's book of assets to $4.5 trillion from $900 billion over the period just after the financial crisis, and shrinking it back to just under $4 trillion, they're like, we don't want to shrink it anymore. So there's room to grow it. Again, there's no limit to grow it. There's no exit plan. You got no limit. You got no exit. You could go in a lot of different directions with that, but it's doubling down on the same stuff that didn't work. And as I said in 2015, in addition to why did banks not do what you wanted them to do because you didn't make them, also, the fact is because you have no limit and because you have no exit plan, this could create a bigger problem down the line. And as long as someone's leading a central bank and down the line happens after they leave, it doesn't really matter to them. But it matters to the rest of the economy. So the other part of phase 2, besides going back into the stuff that apparently hasn't worked for phase 1, otherwise we wouldn't need a phase 2, is that all of what happened in the G7 and all of how sort of the non-G7 major banks like the People's Bank of China manufacture their own money for their own purposes in different ways from those G7 central banks, is that now you got emerging market banks in it. Now you've got other banks central banks outside the G7 who are also cutting rates, who are also trying to say, look, what just happened over the past decade, which may or may not have worked for the larger nations in the world, well, we're going to now do that too. But the thing is, with those central banks, it's a lot closer to the realities of their economy when they manufacture money. There is real inflationary impact. There are real food drive up of prices. There is real shortage that comes from when central banks on the margin, emerging market central banks, do the same kinds of things that G7 central banks do. So that's what we have to look forward to in this world of phase 2, and it's happening all around the world. So I started to get into this a little bit yesterday, but I want to just dig a little deeper. Okay. Just dig a little deeper into the 4 things that I mentioned that it would be wise to be aware of as phase 2 develops. And these are those, and they come out of the book, they come out of what's happened in the world, what's happened in central banks, what's happened at the upper echelons of the financial system, and also what happens in our own lives and with our own companies. And those are the 4 things that I learned leaving that fire in Ojai, which is the town I live in outside of LA, the Thomas Fire at the end of the year before last, which is that you need to be prepared. I know this from creating models. I know this from watching the markets. And I know this because I'm basically a cynical, afraid person when it comes to my own finances and just preparing. You need four things, right? You need to have the fuel to move. You need to have the hard assets to use. You need to have the liquidity to be nimble. And you need to have a plan. You need to have a strategy. Don't be like a central banker. Have a strategy. And that means different things to different people. And it means different things to different companies. But when I look at the investment space, all of those things come into play in terms of how to analyze where investments can be made. In terms of fuel, whether that's old sources, whether that's green sources, it is a thing that is necessary. And so investments are over the long term, and the usage of fuel and the usage of developing natural resources, of developing those assets is an important part of both where money can go for the long haul and where ultimately for the long haul it's needed and can rise in actual value, not just volatile sort of financial asset type of value. In terms of having hard assets, things you can use, things you can turn to that will exist, that cannot be created and fabricated on balance sheets, but that actually have some kind of attachment to the real world. And whether that is real estate that is useful to you or useful to your company, whether that's, and I've seen some exhibits here on private equity or different types of long-term investments in new development, in new lands, in new areas where there can be new potential for that whole sort of geostatistical spatial analysis to find new gold or to find new precious metals or to find new assets. I think that's important. That's an interesting asset class going forward because it has merit, it has use value. Liquidity, we all talked about it yesterday. You need to keep cash aside. And there's different ways to look at cash. I actually, because banks don't always let you take ATM money out after a certain level, I actually use that money and I actually always extract a little bit and I physically keep it. I keep it in a shoe, so I'm giving you a little bit of a secret. But like I have a lot of shoes. But I actually do keep cash in shoes. That's my version of the mattress. But in terms of where to keep it in real things, places where the savings rate is more than what you can get in a big institution. And that goes for people, that goes for companies, that goes for public offices. One should not keep money with big banks because they clearly don't want to repay you on that money, and they don't have to, given the financial monetary system, given they have no constraints on what they can do. And then also, in terms of strategy, in terms of long-term and short-term strategy, always looking ahead. If you're driving through fire, you want to know when you're going to get out, and you also want to know if it's going to come and engulf you right in front of you. So you're basically doing two things at the same time. You're managing your investments from a short-term perspective. You're looking at the massive volatility we have in the market right now, that we have in the world right now, even with all this deluge of fabricated money going into the system, even with buybacks at record highs. All of this is actually still part of an uncertainty that's a disequilibrium between money and financial assets and money and real assets. So the long-term versus the short-term strategy is the other part of those four components of making sure that you're fit, your companies are fit, your wealth can be preserved, your wealth can grow, and you can be prepared for withstanding any emergencies. Is have that exit plan, have that wherewithal to know where you're going in the next 3 months, in the next 1 week, in the next 3 years, in the next 10 years, and so forth. And that's also how I look at assets when I model them. And I also don't believe in any model that doesn't involve continually looking at real data and real events that are going on in the actual world that we live in. So on that note, I think I'm out of time. But I would like to know if you guys have any questions, to thank you again for listening, and to just remember the two phases, the four things, the four pillars of preparation in terms of your investments and your world. So thank you so much. Thank you, Sprott. Thank you, all of you guys.